So let's start. Good evening, class. My name is Wasil, and I'll be one of the lecturers that will be taking you on corporate reporting for this diet. You're welcome to Equity Professional, and for corporate reporting, I would firstly share my objective in this class with you, my general objective with you. So my singular objective first for you guys is to ensure that every one of you pass corporate reporting. That's the first objective we want to assure you that we have. And coming down to the level of the course, which is corporate reporting. The objective of corporate reporting as a course is that before you enter the exam hall, you must have a very good understanding of an annual report. And this is quite different statements, which was the focus of financial reporting in financial reporting, which was the focus then was financial statements. But the focus here is beyond financial statements. Now we are looking at the annual report itself. So therefore, when it comes to corporate reporting, there are some other information in the financial, in an annual report that transcends the financial statements. So the financial statements would be all those statements and the notes to the report. But an annual report would have items like the director's report. It will have items like the corporate governance report. It will have items like integrated reporting in some cases. It will also have items like your corporate governance reports, sometimes social and environmental reports, and a lot of other issues that you would find in an annual report. All of that blended together is what we want to learn in this class. So the objective again is that you must now have a good understanding of preparation and presentation of an annual report. So this annual report, we want to teach you how to prepare and present. We have spread it along 17 weeks because together we have 17 weeks to spend, starting from today till the end of October, 17 meetings. And today, I'll be starting with regulatory framework. When we successfully finish that, we would move on to conceptual framework. When we are done with that, then I will start with IFRS 2 on share-based payments. Then I move on to IAS 19 on employee benefits. Then I move on to financial instruments, where I will teach you IFRS 9 and also some part of IAS 32. Then we move on to IFRS 13 on fair value measurement. Then IAS 36 on impairment of assets. Then IFRS 16 on leases. IFRS 15 on revenue from contract with customers. Then we talk about ethical issues in financial reporting. This is particularly important for you guys at the final level, considering that between now and November, or after November, like December, some of you will become chartered, especially those that are writing all the papers, and you become a professional accountant. you need to act in certain manner. There are certain fundamental principles that you need to adhere to as a professional accountant. So we'll discuss all of that here. Then we'll look at IFRS 8 on operating segment, then IAS 34 on interim financial reports. And we'll move on to analysis of financial statements. Here, we would look at ratios, and my other colleague would teach you EPS. Then we'll move on to other information in the annual reports. So here I'll be talking about items like corporate governance reports, directors reports, and those other reports that like I mentioned earlier. Then we would also look at beyond financial reporting, which are also items, new areas in financial reporting, but they are also within the annual report right now, like integrated reporting, like sustainability reporting, like environmental and social reporting. These are items we are going to cover in this area, and even risk management reporting. Then we'll do group accounts, then cash flow, then income tax. This hasn't even encompassed all I will teach you in this class, because in addition to what I have here, my other colleague will teach you, I think, provisions as well. And yeah, sure, we're going to also look at IAS 24 on related parties. And I know that we're going to look at IAS 21 on effect of changes in foreign exchange rates because of the volatility in the foreign exchange environment right now. I know that ICANN is very much interested in your capability of capturing changes in exchange rate at the end of each reporting period, either at the end of each month or at the end of each quarter. So it's particularly important that we talk about IAS 21 on effect of changes in foreign exchange rates. So those are not listed here, but there are also items we will be looking at in this class. Okay, so if we successfully cover that, then of course you are prepared for your exam. And one thing we will assure you is this: we would cover it. We would cover everything we have to cover in record time, and we'll be as efficient as we can. You're welcome again to Equity Professionals. And the tutors for corporate reporting are myself, my name is Wasil, and Mr. Ibrahim Saka. So Mr. Ibrahim will be focused more on group accounts. He will teach you EPS, income taxes, and some other standards, but he will spend a lot of his time teaching you consolidated financial statements. Why my focus would be on accounting standards majorly, and okay, so introduction. Now, let's get to what we have to do today. So today, I'll be starting with regulatory framework. And when we talk about regulatory framework, we are talking about the regulations that governs reporting generally. And this regulation, I will look at it in two parts. In fact, everything I want to discuss under regulatory framework, there are two things. Number one is the regulation itself that governs reporting. Those we call rules and principles, rules or principles and or principles. And of course, these rules and principles do not develop themselves. There are people that will have worked on them. So we need to know those people as well. And those are the regulatory bodies that develop the rules and the principles. So those are the two things we want to look at in this class. When we successfully do that, then we would move to the next topic. So now, the rules and principles first. So you need to know that these rules and principles are called GAAP, generally accepted accounting principles. In some jurisdiction, they call it practices, but it's popularly called principles, GAAP, generally accepted accounting principles. GAAP is the rules and principle that governs reporting. And in Nigeria, we have our own GAAP. Every country of the world has their own GAAP. All of them has theirs. In Ghana, they have their own GAAP. In US, they have theirs. In Sierra Leone, it is there. In Japan, they have theirs. So every country has a GAAP. So what is a GAAP? GAAP comprises three items. When we say GAAP, then we are talking about national company law, national accounting standards, and local stock exchange requirements. Sometimes they call it local stock exchange listing requirements. So when you look at the company law, national is in front of it. That is appreciating the fact that we are speaking to a local economy, a country, because every country has their own company law. National accounting standard, again, this national is speaking to the fact that we are talking about a local economy, we're talking about a specific country, and also local stock exchange listing requirements. So, and of course, our focus is Nigeria here. So I'll be explaining all of this with respect to Nigeria. In some other countries now, it might be different explanations, right? So let's pick these items one by one because this is GAAP. These three items are the regulation or the rules or principles that governs reporting, GAAP. So the accounting standard, they are the authoritative statement of how particular types of transactions and events are treated in the financial statement. And examples of accounting standard are IFRS, which is International Financial Reporting Standard, and IAS, which is International Accounting Standards. IFRS and IAS, they are the same thing. So IFRS or IAS. And other accounting standards is Financial Accounting Standard. This is used in the US. So this IFRS or IAS is what we use in Nigeria. So our focus is of course going to be on the IFRS or the IAS. So that is the accounting standard. So summarily, the accounting standard is what prescribes, it's what will educate, is what will teach you on how you treat transactions in the books of account, in the financial statement. So if you consummate a transaction, like maybe you made a sales, there is a standard that will teach you how you recognize that in your books. If you acquire an asset, there is a standard that will teach you on how you recognize that in your books. If you make an investment, there is an accounting standard that would teach you how you recognize that in your book. So accounting standards are authoritative statements of how particular types of transactions are treated in the financial statement. Then the company law. Again, I've told you that Nigeria, we have our company law. And why is company law even coming up? in financial reporting. Let me give you practical examples. So an example of a company law is CAMA. CAMA is a company law. And the most recent update to CAMA was in 2020. So we have the Companies and Allied Matters Act of 2020. You see, CAMA provide certain rules that guides companies, right? An example of those rules are rules on issuing share capital, redeeming share capital, the types of share capital an entity must have, and other issues that has a direct impact on financial reporting. It is not all items in CAMA that has impact in financial reporting, but there are some that do, like I've presented to you, issuing and redeeming share capital, types of share capital. So without CAMA telling us that when you want to raise capital, you can either have ordinary share capital, preference share capital, authorized share. In fact, with the most recent CAMA now, it's you must, there's nothing like authorized capital anymore because you're expected to have issued out all your share capital. So without CAMA telling us those types of share capital, there is no way we will have known because there is nowhere in the accounting standard that tells us types of share capital. It only just goes straight to the treatment of equity. It didn't tell us that these are the types of share capital you would have. It only explains equity and the substance of equity. But CAMA does that. And also, when you want to issue share capital, it's CAMA that teaches us how to do that and the types of share capital you can issue, as well as when you want to redeem your shares from your existing shareholder. So CAMA, to a great extent, has an impact on financial reporting, and that's why it's also a company law and also a gap in this case. Another example of company law is BOFIA, Bank and Other Financial Institution Act of 2020. And BOFIA majorly provide rules for banks. It focuses on banks. And an example of those rules is Section 15, subsection 1 of BOFIA that requires banks to make annual appropriation of 30% of their profit after tax if the statutory reserve is less than paid up share capital and 15% of the PAT if statutory reserve is greater than the paid up share capital. It's not like ICANN is going to ask you this, but I'm just trying to point out that there are sections in BOFIA that directly impact the figures in the financial report. So banks will be required to make these reserves provided either of these conditions are met. And you find out that almost all banks, they have to do this. If they don't do it, that's an infraction that they might be penalized for. So BOFIA is also an example of a company law, therefore a gap. And final one is the tax law. Tax law that determines how income taxes are derived. Like the tax you have in the books, it's their tax law. It's actually the tax law that guides us on how we get those figures. Like VAT, for example, now in your books, you most likely have a VAT payable, and VAT would also comprise or be a part of your trade receivable. So without the VAT Act that tells us that, okay, VAT is 77.5% of all vatable supplies that you make, add 7.5. I mean, there is no way you would determine how to determine that VAT. Also, withholding tax regulation also. Withholding tax, let's say you would have withholding tax receivable, you have removed withholding tax from your money. It's the tax law that dictates how much of withholding tax can be removed or you can remove. And recently, I'm sure you must have heard that there is an amendment to the existing withholding tax regulation whereby SMEs would not suffer it anymore, just to free them of that cash flow that they need right now. And also companies in agricultural production and manufacturing industry would not be exposed to those advanced payments of tax. But the point here is this: the tax law has an impact in financial reporting. So generally, company law is a gap as well, because they have an impact in financial reporting. And finally is the local stock exchange listing requirements. And these are the requirements that are presented or put out by SEC, which is the regulatory body in charge of the capital market or the stock market. And these requirements must be met by every company that intends to be listed on that market, or even want to continuously get listed or remain listed in that market, in such a way that these reporting requirements, if you don't meet them, they might not list you. Or even if you had been listed, there are continuous items you must put in your books. There are things they want to see, because listed companies would submit their reports to SEC. So if you don't meet their reporting guideline or even deadline, they can delist you. I mean, the time is here again. Some companies might get delisted, right? Like last year, I'm sure they delisted like few companies. So we haven't heard of that news this year. But as far as this listing requirement is concerned, they have impact as well in financial reporting. So when it comes to regulation in financial reporting, is these three guys: national company law, national accounting standards, and the local stock exchange listing requirements. In this class, our focus is going to be on the national accounting standard. And I've mentioned that in Nigeria, the accounting standard we use is IFRS. So that means our focus is going to be on the IFRS or the IAS. I'm not really going to mention company law anymore. Other courses will teach you that. Or probably you must have learned it somewhere. Local stock exchange listing requirement also is not our core in corporate reporting, so we won't be talking about that. My mandate here is to teach you accounting standard, but that doesn't undermine this company law and exchange requirements being a gap. They are a gap. And if should ask you, which they have asked severally, that you should explain the sources of gap, please, is this three: company law, accounting standard, and listing requirements. But our focus going forward is going to be on the accounting standard. Now, still talking about the regulation, I said these regulation are rules and principles, or rules or principles, right? Are they the same thing? Principles and rules, are they the same? No, they are not. So if you check principles, if you Google principles, right, you'll find out that one of the definitions you'll find there is that principle is a fundamental truth or proposition that serves as the foundation for a system of belief or behavior or a chain of reasoning. Principle is a fundamental truth or a proposition. So a principle will only make a proposal, right? It is not so strict, is a proposal. And this proposal will give you a foundation for you to start thinking, for a system of belief or behavior or a chain of reasoning. So principle provides like a general guide for you to reason. It gives you a proposal that let's do it this way. It's like a general guide. So it's not left for you to make it a finished product or to execute the task based on the general guide that you are given. And that is how IFRS is structured right now. IFRS is structured in a way that they don't enforce treatments in a step-by-step approach. They only give a, a general guide. It's unlike if you use Google Map, for example, now, Google Map will tell you that, okay, when you want to get to Ikeja from Lekki, after 2 kilometers, you turn right. After 4 kilometers, you turn left. After 3 kilometers, you turn right, like that. That is rule, right? And you must obey it. He wants you to follow it step by step. Principle doesn't do that for you. Principle will just give you a guide on how to get there. It's going to give you options, right? Then choose the option you want to follow. Then you follow it through. That's principle. And that's how IFRS is. It's going to give you a general guide and you then tailor it to your business. However, for rule, if you check the English dictionary again, rule are set of explicit or understood regulations governing conduct or procedures within a particular area of activity. So rules are always explicit. They will tell you everything they want you to do. And when they have told you everything, they will now assume that you understand it in such a way that when you don't follow it, it's like you have committed a crime. You'll be penalized for it. So those are rules. So in this class now, right, we need to distinguish those gap we mentioned, that which one is rules and which one is principles. So the gap we mentioned in this class are three: accounting standard. And I've already told you that the IFRS we use in Nigeria is principle. You would understand that as we go ahead. And I mean, a lot of you are already exposed to accounting standard. If you take, for example, IS 16, IS 16 will tell you that when you buy an item of property, you measure it initially at costs, right? So when we say costs, then it then tells us that, okay, cost comprises of the purchase price, of the directly attributable cost of bringing it to its location and condition. So that's a guide. A lot of these costs, I mean, there are different costs depending um on the condition underlying you buying those assets. There are some people when they are bringing their assets to their location, Agbero will stop them, police will stop them, collect money from them, right? So it's not left for you to use your judgment. Should I have this as part of the cost or not? Depending on the guide given. Again, IS 16 will say again that, okay, at the end of the year, you can then either measure these costs, either at cost model or evaluation model. They won't tell you that this is what you have to do, but they will now give you a general guide that, if your asset is highly volatile, use evaluation model. If it is less volatile, probably then you use the cost model. So it is you that will then decide when is it said to be volatile? I mean, we would look at a lot of these areas, but IFRS is indeed principle-based as it gives guide and it leaves the execution to the professional accountant. That's the accounting standard, but that does not say that all accounting standards, because I've just mentioned IFRS, right? Like in the US now, their own accounting standard is, they call it financial accounting standard, and it is said to be rule-based. It is rule-based, right there, because it's very explicit, specific on how you treat items in the books. Company law is rule-based. It is a rule-based framework, right? And also, local stock exchange listing requirement is also a rule-based framework. So if you are asked that in Nigeria now, what is our regulatory framework? What does it look like? Now, is it principle-based or is it rule-based? We can comfortably say that ours is a mixture of rule and principle, because the IFRS is principle-based, while the company law and the local stock exchange listing requirements are rule-based. So they are complementing one another for us here, right? So that's principles and rules. So I kind of asked us before that you should explain the argument for and against rule-based framework, right? And principle-based framework. So that takes me to the advantages and disadvantages of principle-based framework. And an example of principle-based framework is the IFRS, right? It's the accounting standard we use in Nigeria. And the very most obvious example or advantage of a principle-based framework is its flexibility. So IFRS allows for flexibility. Since we allow you to reason, we just give you a general guide. So ultimately, you would be able to tailor those guide to your unique situation, right? To your business circumstance. So it's flexible. It's flexible. So just that, I mean, use it ah, based on what is happening, based on your circumstance or situation as a business. Secondly, is the fact that it allows professional judgment. I mean, with a principle-based framework, it gives accountants the opportunity to be professional. It gives them the opportunity to make decisions, right? Without placing so much emphasis on compliance that, okay, this is what you must do. It only gives you a guide, then you make the judgment, make the call on how you want to present or apply those guides in your books. So professional judgment. And of course, it is highly adaptable, right? For the fact that it's flexible, so you can adapt it to various scenarios, various economic conditions, and various dynamic business environments. So it's adaptable. And also is it allows your transaction to be reported in accordance to its economic substance rather than their legal form. Because rule-based allows for professional judgments and its flexibility, it means that entities are going to focus more on on the underlying transaction. They will not be so much concerned about the step-by-step treatment of items. They would be focused more on the uniqueness of their business environment and that transaction in question. So in such cases now, you find out that you are going to have an accurate representation of the company's financial reality. So which is what economic substance means. You would present the underlying transaction. You would present the economic and financial reality of those transactions rather than focusing on compliance or legal form. So it's also an advantage. And another very obvious advantage is global acceptance, because IFRS is widely accepted and adopted by over 144 countries. Therefore, it's easy for international business to occur. It's easy for international investments to occur. So we can take that as an advantage also. because of the global acceptability of IFRS is an advantage. And also, of course, it will facilitate global business indirectly, right? Because if my investor, my foreign investor in Australia, right, they understand IFRS, that's the standard they use in their country, and they invest in a company in Nigeria. So when they want to send in their reports and is IFRS compliant, so it makes things faster and easier. And those investors would be confident that you have reported in line with a reporting language that they understand and they accept. So these are advantages of a principle-based framework. Of course, there are disadvantages to it. And the very first is challenges relating to consistency. You see, everything that is flexible cannot be consistent because different people would look at it in different ways. So consistency and comparability might be missing, right? Because it's flexible. So it's a disadvantage. Challenges in consistency. Another one are concerns about transparency because you have allowed professionals to use their judgments. A lot of entities might turn out to be unprofessional, right? So when given opportunity, they might misuse it. And instead of presenting a true and fair view, they might end up obscuring the negative aspects of their financial health. They will only show you what they want you to see. That's possible with a principle-based framework that allows you that gives you the freedom to present in a way that aligns with your business environments and the uniqueness of your industry. So concerns do exist around transparency. And also is the risk of manipulation. This is similar to the earlier point that financial statements might be prepared to the advantage of management. They might manipulate the financial statements. You find out that these guys will become creative. They would window dress the books and they would execute a lot of shenanigans that they should not. So that risk do exist that they could manipulate the financial statement. And the challenges of varied interpretations. We are talking about principle-based being a general guide. People will interpret it differently. Becomes a problem. And because of that, then application might become complex, especially entities that have diverse operation or where the operations is really complex, right? So applying a principle-based approach might become difficult and seriously tedious, right? So it's a disadvantage. And also, legal and regulatory challenges could then occur. Yes, because there are potential of misleading investors. So you find out that um, investors might start having disputes with entities. Regulators might also start running around entities and challenging their reasoning for treating it in one way or the other. So these are disadvantages of a principle-based environment. Now, for a rule-based environment, the clear advantage is the fact that there's clarity and specificity because rules like the US gap, for example, now, it's specific, it's clear, it's detailed. It tells you step by step what they want you to do. So it's clear. Nobody can say that I thought it was. No, it's there. It's already step by step. Clarity and specificity is there. That is an advantage, right? And the second one is, of course, it's easy to compare. Everybody would have done it the same way. Because if you don't do it that way, it's an offense. So comparability will be greatly enhanced and there won't be ambiguity. There won't be. It's clear there will be consistency in treatment. There would not be ambiguity in accounting treatments. Everything is clear because it's step by step. And a lot of entities will then have to comply because this is the rule. You don't comply is at your own peril because there are penalties, there are consequences for non-compliance. So legal compliance will be increased. So investors will like this. They will like it because they know that nobody can mislead them, right? And legal certainty. Companies also know that they don't have any unnecessary legal exposure and they know that there might be little or no disputes between them and their investors. So ultimately, it will enhance financial reporting, confidence in financial reporting. So clear advantages. Then disadvantages is the fact that it's rigid. I mean, speaking to the fact that it does not align or appreciate uniqueness of businesses. Okay. So it does not look at the economic substance of transactions. It focuses on what they want you to do. It's not ready to adapt to dynamic business environment changes and what have you. I mean, rule will be difficult in an environment like Nigeria, where regulations are flying around every day, where the business environment is highly unstable, where government can wake up one day and increase electricity tariffs by multiply by five folds, right? That would make even a company that was making an 100 million profit start declaring losses, where the exchange rate environment can just somersault and turn everything upside down, where a lot of unexpected things will just happen. So every day you wake up and getting ready for the unexpected. So rule-based framework might be difficult to work in an environment that is very uncertain and highly volatile. So it's a disadvantage, rigidity. So second one is the potential for a checklist mentality. So when the focus is on strict adherence to rules, so all accountants will just do is they already know what they want to do and they will just do it. So little focus will be placed on the economic reality of the transactions. Why the ultimate focus will just be on compliance. Let's do what they ask us to do, even if it doesn't make sense to your situation at that point in time. You just have done it. So I've done it. So you find out that there will be a mismatch somewhere. So potential for a checklist mentality is a disadvantage. And it might result in complexity. So for a company that has a diverse operation, following a step-by-step might be tedious, might be seriously tedious, right? So complexity. Another one is risk of over emphasis on compliance, right? Like I've mentioned before, they will just want to comply. And in a dynamic environment, they will need to update those rules frequently. They have to be changing it to meet what is happening in the environment. And also is varied interpretation for the rules or for the step by step. So that is also a disadvantage. So I kind of asked this in several ways for you. And at your level, you need to know these points, but you need to have like a conviction of which framework do you think we should adopt as a country? Me, I think principle-based is okay for us and meets the disadvantage of that consistency is an issue, transparency, but the fact that it's adaptable, the fact that it allows people to reason, and make judgments. I am a principle-based guy. So other people can think that, okay, they are rule-based. I mean, we appreciate the fact that IFRS is principle-based, but discussions are ongoing, as you would see. That now is also becoming a mixture. IFRS is becoming a mixture of rule and principle over time. Okay, so these are things you need to be thinking about, and you need to have a stance, and you must be ready to articulate your stance in the exam, as the examiner would at this level want to hear your opinion. We do not focus at this level on you just churning out lists of items, but rather we want your honest professional judgments in the exam. And as we go through this topic or this course, you would find out that a lot of our discussions we would want to hear from you, and want to have your opinion on events and transactions as it were. Okay, so I'm done with the regulation. I'm done with the regulation. Now, the next is the regulatory bodies. But because I can't see you guys, I don't know who is understanding and who is not. I can't read your body language. I mean, so there will be quizzes just to be sure that you're following. So let's look at these simple quizzes together. So the first one, oh, definitely, we're going to share the notes. So the quizzes we have. Number one, financial reporting is governed by regulation. True or false? Okay, so this is the part where you talk. Okay, true. The second one, the rules or principles that governs financial reporting is known as
Gap. A.
gap. That's correct. Which of the following is not a gap? Which of the following is not a gap? National.
National tax
National
laws.
tax laws.
That's correct. National tax. That's an odd one out there. Okay. And finally, IFRS is a rule-based framework. True or false?
False.
False.
Fantastic. Okay, good. So again, let's move to the regulatory body. In Nigeria, the regulatory body in charge of IFRS is called the Financial Reporting Council of Nigeria. They came in 2011 to replace the National Accounting Standard Board, right? So they were brought in by, of course, an act. There's an act backing them up of 2011. So before that 2011, we were using a standard called SCS. So when they enacted this FRCN, so we started using IFRS in Nigeria. So the whole journey started from, let me say, 2012, 1st January 2012. FRCN. FRCN is a popular body that I believe every one of you seated in this class should know, because I'm sure there are some of you here that might be MDs of companies. So you might have an FRCN number, or maybe you're a CFO. You must have an FRCN number, because before you can sign an account, you must have an FRCN number. If you don't have, you cannot. If you do, you're in trouble. They will come after you. So, and if you belong to Institute of Directors, I mean, you could be allowed to have an FRCN number. But the easiest way for us accountants is, as soon as you have your ACA, FRCN will give you a number, because at that point, we believe that's the route to becoming a CFO. However, do any of you know the current MD of FRCN? Is there anybody that knows him in this class? Anyone? Anyone? The current MD of FRCN. Okay, no problem. If you don't know. Okay, so let me try and relate things together. Let me try and relate things together. So, okay, so the guy was he used to be the former commissioner of finance of Lagos State during the first term of Sanwo-Olu. So they didn't use him in second term. So they made him MD of FRC, and his name is Rabi Olowo, Dr. Rabi Olowo. So he came in last year. Before him, I don't even know who was the MD because they had not been doing so well in those periods, right? So, but the first guy that came up as their first MD was Jim Obaze. So that name should also ring a bell to some
Omega.
of it. Sorry, that
No,
name
I'm just
should.
saying tough.
Yes. Yeah, you will see, he was that guy that investigated CBN. All the issues Emefiele is facing today was that guy that went to dig out everything. He's a tough guy, and he knows his onions. So when he was the MD of FLCN, FLCN was extremely active. That was when a lot of accountants registered. They were really doing their job. I mean, at that point, every company was submitting their account to FLCN because you have to submit. You have to. And they will sit down and look at accounts. I was surprised when they called then in 2013. They called one of our clients. So we were the tax consultant, and they had an auditor. So they looked at the account and they saw that there was an issue with the treatment of employee benefit. They invited the tax consultant, they invited the auditor, they sit all of them down. They explained to you that this is the requirement of the standard, this is what you did, why? And they would explain, you guys would discuss. After they have finished explaining, they will now send you penalty that please record these accounts. Please go and treat it properly. They were doing so well until they removed the guy, right? And I don't know, the guy was trying to do his job. At that point, it was during his era that banks, all these um, Jim Ovia, Tony Olimelu. That was when they had to step down. That was when they started this 10 years rotation for for most of these banks. And also, he was even trying to implement this for even non-profits. That's
Or
he
touches.
suggested. Yes,
Mm.
yes, yes. Even for churches then, that he suggested that Pastor Adeboye should step down, which he did until presidency stepped in and sacked him that, Ogbeni, you're already doing beyond your portfolio. That was why the guy had to leave. And after he left, FLCN has not been doing so much until Rabiu came in. Rabiu is a young man. I think he's under 40 or 40. I'm not sure. He's a very young man. And he has started doing well now because I heard on the news last year, there was a, a federal government parastatal that had to recall their accounts because of issues with FRCN, because of treatment of certain items there. So they are coming back gradually, but it's going to take time. They are trying, but let's see how it goes. But FRCN is very powerful. It's very powerful. So that is just a brief practical into FRCN. Now, they have objectives. They have objective, and one of their most important objective is to protect investors and stakeholders' interests. To protect investors and stakeholders' interests. Yes, this is their core mandate because the whole of FRCN is all about ensuring that companies prepare the right reports. And whom are we even preparing this report to? We are preparing it to those that have dropped money for your business, the investor. So a body that is trying to ensure that the report they give to you is right is protecting you. So their core mandate is to protect investors and other stakeholders' interests. And they know that for them to do this, They need to then provide guidance on issues relating to financial reporting and corporate governance to professional, institutional, and regulatory bodies. And what this second point means that it means they teach, they educate professionals on issues around financial reporting. They educate people around IFRS on how to prepare accounts, on auditing, and also on corporate governance. You would agree with me that an entity that does not have good corporate governance structure, there's high possibility that its financial reporting might not be accurate and reliable. And when I say corporate governance structure, is how a company is controlled and directed. So when you have a CFO that reports to an high and mighty MD, that the MD can tell the CFO that, please, this 30 billion revenue you have disclosed or recognized in the books cannot fly. My investors might not be happy with this. Let's find a way to make it 35 billion. And the CFO will say, yes, sir. And we'll go and do such an adjustment. No corporate governance. A corporate governance exists where the finance director or the CFO, as the case may be, don't 100% report directly to the MD, but report to an audit committee of the board, right? That the MD does not supervise. So in such a way, the CFO will have certain level of independence and his financial reporting will be right? So FRCN tried to educate professionals around these issues, financial reporting and corporate governance, trying to ensure that they do the right thing. So they teach, okay? So after they have done the teaching, then they will now ensure that companies actually do it. First, they would ensure good corporate governance practices in the public and private sector. So FRCN is not just private companies, whether listed or unlisted, even government entities, government business entities. They also ensure they have good corporate governance. Then they will also ensure that they actually prepare the reports very well. So ensure accuracy and reliability of financial reports and corporate disclosures. Okay, so these first four objectives, they follow one another sequentially in such a way that you can logically think it out. So looking at the first one, which is, okay, we want to protect investor because it's because of them. When the reports are right, then they are protected. For us to do that, we need to teach companies about financial reporting and corporate governance. Then after we have taught them, then we need to ensure they do it. So we need to ensure that they have good corporate governance practices. We need to ensure that their financial report is accurate and reliable. They used to do all of these things. They have stopped. Most companies now, most accountants don't know that they are supposed to submit their reports to FRCN. Nobody does it anymore. They don't even ask. They don't, and they are supposed to be doing that. So also, another objective is that they are supposed to harmonize activities of professional and regulatory bodies relating to corporate governance and financial reporting, like the ICANN of this Nigeria, ICANN, ANAN, name them, all of these professional bodies that has input in corporate governance and financial reporting. They harmonize their activities. They are their ultimate supervisor. And also, they promote highest standard among auditors and other professionals engaged in financial reporting process. Yes, they were really doing this. So that's why it's not just accountants that register with FRCN. Lawyers register with them because lawyers might need to draft certain contracts, and that contract will have impact into our financial statements. So before you can do that, you need to have an FRCN number because on your report or on your contract, you need to quote your FRCN number. Valuers that want to value maybe your assets and others, they also need to register with FRCN because on their valuation report, they need to quote their FRCN number. All these things are not being done anymore. But by ensuring that only professional does these things, they are promoting higher standard. They are promoting higher standard. And also, ultimately, they will then achieve credibility. So they will enhance the credibility of financial reports, and also they would improve the quality of accountancy and auditing services, actual valuation and corporate governance standards. Okay, so that's the way it works. So usually before, they used to go out for audits. They used to ensure that only people that have FRCN number sign. They will ensure that companies submit their financial statements. And if you don't do all of these things, it's an ethical issue. They can penalize you, right? But now, I don't know. So they have departments. They call them directorates. So they have directorates of accounting standards, both for private and public sector. They have Directorate of Auditing Practice Standards, Directorate of Actuarial Standards, Directorate of Valuation Standards, Directorate of Inspection and Monitoring, and Directorate of Corporate Governance. So it's just to ensure that they fulfill their responsibility in an efficient way. Each department have what they handle. Okay, so that's that with FRCN. Very quickly, I need to tell you that, yes, FRCN are the one in charge of IFRS in Nigeria. But at your level, every one of you seated here, I'm sure you know that FRCN are not the ones that actually develop IFRS. They only adopted it in 2011. They just adopted it. They did not develop it. So I mean, it's fair that we know who actually develops this IFRS. So I call it IFRS Foundation three-tier structure. So it's a complete structure behind IFRS. And this three-tier structure, I explained it like this. I said the IFRS Foundation has a three-tier governance structure based on two independent standard setting boards of experts, that is the IASB and the ISSB. So these are standard setting boards of experts. And these two standard setting board, they are governed and overseen by trustees from around the world. Those ones are called IFRS Foundation Trustee. We in turn are accountable to a monitoring board of public authorities. So those are the three-tier structure. From this structure, you will see there is the monitoring board, who is the boss. There is the IFRS, who monitors the IFRS Foundation trustees. Then the IFRS Foundation trustees monitors the standard setting board, the IASB and the ISSB. So let's quickly look at this, right? So the monitoring board first. These guys are there to ensure that this entire structure has public accountability. So they kind of provide a link between the structure, let me call it trustee, and the public authorities. All right. And when I say public authority, it's really speaking to the people that comprises this board. The people that comprises this board, this monitoring board, they comprise or they consist of capital market authorities. Those are the people that are there. And when I say capital market authorities, I'm talking about, for example, in Nigeria, our capital market authority is the SEC. They are the one in charge of capital markets in Nigeria. So imagine the SEC of other countries, like that of the major countries, of course. They are the ones that are in the monitoring board. So you would then agree with me that the people in this board are those that understand what is obtainable by companies in terms of reporting requirements. They are the one that understand what company needs. They are the one that understand what shareholders need. So they have this understanding. They can easily picture what the structure should be doing. They know because they are the capital market authorities of the world. So that is the monitoring board. And their main responsibility is to ensure that people under them, which is the trustee, they ensure that they do their job. And of course, they are the one that appoints them. Then we appoint as well. So that's the monitoring board. Is very straightforward. It's just to ensure that this structure makes sense. It's just to ensure that this IFRS structure that we have, these guys in charge of IFRS are practical. Like they are doing what they should be doing. So they provide a link between the structure, the trustee, and the market. That's why their members are capital market authorities. And capital market authorities like the Board of International Organization of Securities Commission, IOSCO. IOSCO, like almost the capital market authorities of almost every country in the world is a member of IOSCO. So there is the IOSCO Growth and Emerging Markets Committee. There is the Financial Services Agency of Japan, the European Commission, and what have you. I can't only ask you to list this. I can guarantee you that. So just know these things and appreciate it. So that's the monitoring board, right? So they ensure that the trustee does their job. Now, the trustees themselves, who is the IFRS Foundation? So this IFRS Foundation, the people there, we call them trustees. Trustees. And they have 4 key objectives. The first is to develop in public interest a single set of high quality global accounting standard. So that goes to show that is the trustee that is actually responsible for developing IFRS. So to develop in public interest a single set of high quality global accounting standards. So right from day one, these guys are set out to ensure that every country of the world uses that IFRS. That's why their objective is single set of high quality global accounting standard. Second is to promote the use and rigorous application of those standards, which is to ensure that people use it. And they have achieved that. I mentioned earlier that 144 countries, that's a lot, uses IFRS. How many countries do we even have in this world? 144 countries already using IFRS. So it's huge. So, I mean, it's worth it if you are qualified chartered accountants in Nigeria. You can easily be the group CFO of West Africa. You can even be the global CFO because most countries adopt IFRS. So the major part of your work will just be translation. It won't be how items are recognized or treated anymore. It's just translation, right? So IFRS makes sense, right? The third one is to take account of the special needs of SMEs and emerging economies. I mean, they were very smart with this third objective and it helped them. So they helped SMEs, they focused on SMEs and emerging economies. And that's why most countries in Africa, if not all, uses IFRS. I mean, most countries, even in Asia, South America, most of them uses IFRS. So they of course, Europe, that is where IFRS originated from. So in UK specifically, so they have strategically captured everybody in the world with this their objective. And finally, their final objective is to bring about the convergence of national accounting standards and the international accounting standards. They know that there will be some countries that will not want to adopt IFRS. So, and that's where this fourth objective comes in, to converge. That, okay, even if you don't want to use IFRS, can our reporting language look similar. I mean, let's sit down and think through it together. And that's what they're trying to do with the United States, because United States is not adopting IFRS. Like the new IFRS 15 we had was as a result of convergence with United States. The IFRS 16 on leases was a result of convergence, right? Even this IFRS 18 that is coming up to replace IAS 1 as a result of convergence with the US, the IFRS 9 that came up to replace IAS 39 is also a result of convergence. So they are really trying to ensure that reporting requirements are the same all over the world. So you need to know this objective for the IFRS foundation, and it's extremely logical again. These guys, these trustees, because in fact, they comprises of people that that are all over the world. Like we have one representative from Africa. I think they have two representatives from Australia, even Antarctica, then South America, North America, Asia. So every continent has a representative. So they are well grounded with what is happening all over the world. So they are duly qualified to actually develop a global accounting standard. And these trustees are appointed for a renewable term of 3 years. Okay, so that's the trustee of IFRS Foundation. Now, these trustees, they now have people working under them. Okay, so these trustees is like the management. The monitoring body is like the board, like the top guys, the board of a company, for example. The IFRS Foundation is like the management, the guys that carry the objective on their head. Then the delegates, they are the one responsible, oh, but of course, a leader must delegate. And when you delegate, and those people you delegate to, your delegatee, if they fail, you fail. So they have two people under them, the IASB and this new one that just came up, the ISSB. So those work under, it's very clear in this table that I have here, this table here. So under the IFRS Foundation, we have the IASB and the ISSB. So the objective of the IFRS Foundation is the objective of the ISB. They carry it on their head as if it's their own. So if by mistake, I can ask you, you should state the objective of the ISB. Please kindly state this for objective, because that is it. So the core mandate of the ISB is to develop and approve accounting standards, IFRS specifically. And also, they also do IFRS for SMEs, as well as interpretations on IFRS. Okay, that's the core mandate of the ISB. And again, members of these ISB also are people that are professionals with international practical experience, people that are experts in auditing, in preparing financial reports, in accounting education. They have to be experts for you to be a member of ISB. However, we know that what the ISB does majorly is to develop and approve IFRS, including IFRS for SMEs. They also develop and approve IFRS interpretations, but they delegated that to, for the IFRS interpretation, they delegated that to IFRS Interpretation Committee. So this one is under the ISB. So majorly, these ones are focused on interpretations on IFRS. And yes, they interpret IFRS, the interpretation committee, but they only come up with interpretation where there are different possible interpretation of an IFRS, of an international accounting standard. So whenever there is an IFRS and people are interpreting it in different ways, Group A is saying, this is how it should be treated. Another party is saying, no, this is how it will be treated. So the IFRS Interpretation Committee will come up that, okay, this is how we should treat it. Also, where there are issues that are not covered by an IAS or IFRS, they also come up with a timely guidance, like on cryptocurrency, for example, now. Right now, we don't have IAS that covers cryptocurrency. So they came up with a guide that, okay, this is how we should treat cryptocurrency pending when we resolve with a standard, if need be, and some other areas in reporting that are new. So they come up with that. And of course, they publish draft interpretations for public comments. Ultimately, this interpretation will be approved by the AOGA, which is the ISB, but they are the one that work on it. Okay. And before I look at these guys, IFRS Advisory Council, let me go to this ISSB, International Sustainability Standard Board. They are new because they came up in 2021. And their focus is on sustainability standards. So they would be coming up with IFRS sustainability disclosure standards. So Nigeria has adopted it last year around October. So they have already issued IFRS S1 and S2, right, which we adopted already. And it's part of your syllabus. Sustainability reporting is part of your syllabus. So when I'm teaching you sustainability reporting, I would make mention of IFRS S1 and S2. I doubt if I can would directly ask it, right? But I mean, it's good that we have a standard on sustainability reporting right now. So when we get to that junction, I'm sure we would efficiently and easily cross it. So that is the ISSB, focused on sustainability. Okay, so we'll learn about what sustainability is, relating to ensuring you don't destroy the environment, ensuring that when you cut one trees, when you cut a tree, plant another tree, ensuring that you have good employee practices. I mean, just making sure that your activity does not prevent the future people from living. Don't kill everything right now because you want to leave. So we would talk about all of that. And finally is the IFRS Advisory Council. And from their name, you will see that what this guy will be doing will be providing advice. So they are the one providing advice to everybody, right? Except the monitoring board anyways. So they will provide advice to the IFRS trustees, foundation trustees. They also provide advice to the ISB and also to the ISSB. So that's what this advisory council does. And in addition to that, the advisory council would also help the ISB and ISSB to obtain public comments and opinions whenever they need it. They do help them to obtain public comment and opinion, right? So that's their core mandates, the IFRS Advisory Council. Okay, so that is that for the structure behind IFRS. So I need you to be able to draw up this summarized structure I have here. If you check the IFRS.org website, the IFRS Foundation website, you will find this structure here. The way I draw it, that is where I picked it from. So you need to know it. You need to know what the monitoring board does, the IFRS Foundation trustees, the ISB, ISSB. I mean, in summary, you need to have an idea of it as a corporate reporting student. Note that IFRS and IAS are the same, but before IFRS, we used to have IAS, but from 2005, things changed. Then we are gradually moving towards IFRS in such a way that most of the standards that are being amended now, because we used to have IAS, then IFRS came up, but they cannot wipe out all IAS. So IAS and IFRS are still, I mean, they are the same thing. But like for example now, when we used to have IAS 18 on revenue, but when they amended it, they changed the name. So we don't have IAS 18 anymore. Now we have IFRS 15. So we used to have IAS 17 on leases. When they amended that standard, we don't have IAS 17 anymore, but now we are having IFRS 16 on leases. We used to have IAS 39 on financial instruments recognition and measurement. When they amended it, we don't have IAS 39 anymore. Now we have IFRS 9. So gradually, they are replacing all IAS with IFRS. So maybe in another 4 decades, they will have finished doing that. Right? So it's IAS is with us for a long time. I mean, for our own lifetime. Everybody here. IAS is not going in our lifetime, believe me, because a lot. So that's that. Yeah, so that's that. So that is it for the regulators. So for the regulator, we have looked at the ones for Nigeria, which is the FRCN, and it's also fair to look at the guys that actually do the work, which is the IFRS Foundation three-tier structure, which I've taken my time to explain to you guys. So to be sure that you were following, let's look at these quizzes together. So quiz one. Which of the following bodies provides the formal link between the trustees and capital market authorities? A, ISB, B, IFRS Advisory Council, C, Monitoring Board, D, IFRS Interpretation Committee, E, IFRS Foundation. What was the answer?
We see that that
IFRS.
organogram again, where you show the different bodies.
Okay. Yes, yeah. So Mohammed said is B, and Adeteju said is C. So let's go and see B and C. So B, IFRS Advisory Council, no. So Adeteju is right, it's the monitoring board. So it's the monitoring board that provides the formal link between the trustees and the capital market authorities. Don't forget, I told you that the monitoring board comprises of the capital market authorities that ensure that this structure makes sense, they are practical. So they link with capital market authorities. Okay. Then the second one is one of the following is not an objective of the IFRS Foundation. A, to help companies prepare and present financial statements. B, develop in public interest a single equality accounting standard. C, promote the use and application of the accounting standard. D, to take care of the needs of SMEs and emerging economies. So which of the following not an objective? A, that's correct.
A.
That's very correct. That's correct. So the third one, which of the following bodies is responsible for developing IFRS? A, ISB, B, IFRS Interpretation Committee, C, IFRS Advisory Council, D, IFRS Foundation.
Is that not A?
D.
I think it's A.
Okay, somebody said A, another person said D. So I need one more person to support or against. Let's see. D, A, or D? Mohammed said D. Yes, D is correct. It's the IFRS Foundation. So yes, you know that we know that the ISB are they are the ones that develop IFRS, but Is the core mandate, is the objective of the IFRS Foundation. So IFRS Foundation just delegated that to the ISB. But if they ask us who is responsible, it's IFRS Foundation. So if in the option IFRS Foundation is not there, you now found ISB, then you can be talking about ISB. But where ISB and the IFRS Foundation is in the option, of course, it's the IFRS Foundation. You already delegated it to the ISB. So the next one, where there are conflicting opinions on the interpretation of an IFRS, which body resolves this conflict? ISSB, IFRS Interpretation Committee, IFRS Advisory Council, Monitoring Board.
B. Yeah, advisory. Yeah.
It's actually the Interpretation Committee, not the Advisory Council. So they are the one that provides interpretation of an IFRS where there are conflicting opinions. So it's the IFRS Interpretation Committee. Okay, so this quiz is actually very good for a theoretical exercise like this one. So it shows that some of you are following my, some are not. But when you read, you would get a good grasp of it. Okay, now the final part of this topic is a setting of IAS. How do the IASB actually develops? How do they develop accounting standards? Is the the IASB that does that? How do they develop these accounting standards? So the way they develop accounting standard is an inclusive and transparent due process. And inclusive in the sense that they ensure that the best thinking, the smartest people is involved. And transparent in the sense that everybody sees what they are doing. So it's not like some people sit in a corner and start writing, this is how we should do it, this thing. No, everybody is an inclusive and transparent process. Nothing can beat that. Nothing can beat the wisdom of the public. Nothing. Where everybody thinks together and produce a result is not. No singular person can sit down and achieve something similar. It's not possible. It's not possible. So let's go straight to that step. So the step one is agenda consultation. So the first thing they do is they will do like a comprehensive review and they will consult with professionals that is there any accounting problem that they need to resolve. So if there are any, they would put it in a work plan. They have a work plan. So this they update every 5 years. So every 5 years, they're having a work plan. They have things they want to work on. So that's the main point of agenda consultation, is just to consult with professionals in practice, in business, everyone. They let us know if there are challenges, accounting problems that are new that we need to work on. So that's the step one, generally, consult. So the outcome of this consultation, they codify it or document it in a project work plan. Now, then they will then go to research program, which is the step two. So the most pained, the most urgent accounting problem, they will then enter into research. to identify possible solutions to that accounting problem. So first, they will even try to identify that this problem does it even exist. Is it actually valid? Is this something that we should work on? Should we devote resources to work on this accounting problem? So they would carry out a research, come up with research questions, come up with solutions like that. And all of this, they will codify it in a discussion paper. Discussion paper. And the way they will know whether the problem is valid or not, they will send out this discussion paper to the public. People will comment. People will state their view about the accounting problem. So if you go to ifrs.org, you register there, you'll be receiving some of these things whenever they have one. They will send it to you. So you also put your comments there, you read it, put your comments like that. So eventually, they can be on this step for 3 years, 4 years, because they won't just throw it once. So they will throw it, people will comment, they would look at it. If they are not satisfied, they will return it, additional comments like that, back and forth. So it could take years before they are satisfied. So the outcome from this discussion paper is either that, okay, yes, there's really an accounting problem that should be worked on here, or no, there is nothing serious here. Let's just abandon this and move on. Okay. So if they abandon it, then that step ends here. But if they decide to get involved in that project, then they go to step 3, which is the standard setting program. So for the standard setting program here, the core here is they would develop a proposal for a new accounting standard, or if it's an amendment to an existing standard. So that proposal will be codified or documented in an exposure draft. So they would codify it in an exposure draft. So exposure draft. So this exposure drafts, they will send it out to the public. People will read it. So what you will find there is actually, okay, let's say they come up with, well, let's say the accounting problem is Bitcoin or cryptocurrency generally. So they will come up with like a definition for it. They will come up with recognition criteria. But now they will not have different alternatives for it. So it's always very bulky. They will come up with different measurement bases. So you will read it, you will send in your own comments that, okay, this is the recognition that I choose that I think is okay. You send in your comment on those exposure drafts like that. So on this step, on this exposure draft step, they could be on it for years as well, because it's the exposure draft that they will now narrow down, that they will not have a singular recognition criteria, the measurement basis that they choose to use, the disclosure requirements, the basis of conclusion, all of those items will be there. Then after the exposure draft, then the ISB refines the exposure draft, then they will come up with a new accounting standard or an amendment to an accounting standard. Okay, so look at the step. Step 1, in some textbook, they didn't do it the way I've done it here. The way I may have done it is the way it is on the IAS, on the IFRS.org website. In some books, their own step 1 is work plan. Their step 2 is discussion paper. Their step 3 is exposure drafts. Their step 4 is accounting standard, like that. But it's actually agenda consultation, research program, standard setting program. Then is at this step, they get to accounting standards. Then it doesn't stop there. There are maintenance program. Because when the accounting standard is now out there, they need to continuously ensure that people can consistently apply that standard. And if there are challenges with implementation or application, that is where the IFRS Interpretation Committee would decide to create an IFRS interpretation for the accounting standard that, okay, this is how we should interpret it. So they continue to monitor it. So I kind of asked this before, so you could ask it again at your level. So those are the standard setting process. The next one here is adoption of IFRS in Nigeria. I'm not going to talk about this because this has passed. They will never ask you this one because we have passed that stage. The last set of companies that adopted IFRS were SMEs, and they have done that since 2014. So right now, every company is expected to be adopting IFRS as we speak. So there is no point talking about this. So the final part of this topic is the need for regulation. Why do we need regulation in reporting? It's very important because without regulation, there would not be a way to enforce compliance with GAAP, with IFRS. People will just be, they will not be, it's regulation. For having a regulatory body, now we can enforce compliance. People would then be able to, would ensure they prepare accounts the right way. And also, regulation ensures that users are provided with information that is relevant to their decision with regulation. And also with regulation, similar items would be treated in a similar way with regulation, would ensure that things are same. So its comparability becomes relatively easy. And also, with regulation, management cannot mislead the users. With regulation, they cannot mislead the users. Okay, so that's that. So in the past, so these are some questions, past questions at skills level. At professional level, May 2022, I can ask you guys what are the major benefits and major criticism of principle-based accounting standard. I think I've mentioned the advantages and disadvantages of principle-based framework. So for 10 marks, that means you need to give them 5 advantages, 5 disadvantages. Another one is what are the consequences of transiting from a rule-based to a principle-based? Just tell them about advantages and disadvantages of rule-based. It's just so consequences of transiting, right? Then in May 2022 again, they say you should appraise the rationale behind different regulatory framework for financial reporting. So I think this one is the need for reporting. Why is regulatory framework important? Why is regulation important? 8 marks. Then also, they say you should analyze in detail the various sources of regulation. And that's where we are talking about accounting standards, the company law, and the local stock exchange listing requirements. Now, that's where we're talking about those other guys there. So that's the end of this topic for today. If we are lucky, ICANN would ask it. If they don't ask it, that means you have to battle with other questions in the exam. All right. So let's see how it goes. And do you have any questions for me before we decide the next thing we're going to do tonight? Okay, so there are no questions, and the time is already 10:30. Is a time well spent. So before I plan to start the next topic, which is conceptual framework, but let me welcome you to Equity Professional. 1 week is gone. We have started counting down. So practically we have 16 weeks to go now. We will joke less because we have very little time. 16 weeks, it's a long time really, but just that it comes by very fast. And at your level now for corporate reporting, you have to, in a way, be comfortable with most of these things so that you can pass. You read it over and over again. Like I've taught you this today. I'll share this material with you, maybe with those that have paid anyways. So you share it, then you look at it, you start studying it. Then next week we do another one. You start looking at those ones and studying those ones as well. Then it continues to pile up and pile up and pile up like that. So let's see. Next week, which is not next week, I should be coming up next week, but I'm not sure if Mr. Ibrahim is ready for class this week. If he's going to be available, that means he will be taking the next class on, I think it's on Friday. If it's not going to be available, that means I'll just have to come and take conceptual framework. We'll also start and finish it. Then when I'm done with conceptual framework, everything is here. I can decide to send you these entire notes if I want to, because everything I want to teach you is already collated in one document. I move to IFRS 2, then continue to move like that swiftly in this class. But for now, we're going to stop here. So if you don't have any question, I think we would have to call it a day. Somebody is asking that did the syllabus change? No, the syllabus did not change. And there is nothing like SBR. It hasn't been just rumors. Rumor. The way it works is that if ICANN wants to change syllabus, they will have sent in the draft syllabus to all tutorial center, everybody, to study and prepare. So we'll have like a year or 6 months to prepare a whole diet so that we would, if there are changes, we'll update it. So I don't just, So it's just rumor. There's nothing like that. It doesn't exist. So it's still corporate reporting. Nothing has changed. So we are still good to go for this diet. So I would just implore that if you are writing this exam, just ensure you pass it. Don't let change of syllabus meet you here. Ensure you write this diet, right? Write it and just move on from it. Okay, guys. So it was nice meeting you guys today. I will see you in my next class. Do have a wonderful night. Bye bye.